Okay. Good afternoon, everyone. Hope you're enjoying the day, enjoying the nice weather out there, getting some vitamin D. I'm looking forward to going out there and getting some of that. I just want to thank you guys again for joining us this Saturday, and welcome to the third week in our series. And let me just see, something is missing here. Welcome you to this third week of our series. I'm excited about what we're going to talk about today, because there's a lot of information that can change your trajectory when it comes to getting financially free, because this information is so critical as to what we do. So again, welcome and welcome and welcome. Let me move on. Again, I introduce myself. Ralph Hastings-Spaine with Simplify Wealth Builders. And as I always say every week, my passion is to teach and help families and business owners prepare for successful financial retirement, because I believe that should be the most exciting time of our life. After we've given everything to take care of our kids and help them, become valuable members of society. Now it's our time to have fun. So I love to talk and help people prepare for that. Simplify Wealth Builders, we're a financial education company, and we do workshops similar like this one. And I'll just throw it out there. If you have a group that is looking to get some financial education, and you're part of a group where they do financial literacy, you can reach out to me, and we'll be able to work with them and help them provide some education for them. I'll start with a quote for our series by Benjamin Franklin. It's by managing your finance that you write the story of your life, that you're both the author and the story's principal character. So resolve to perform what you ought. So that's our quote for the series. Again, today, I'm happy to have my good friend with us, Minister Antonio Chicks. He's going to continue his teaching on Lead Now, the shape of self-leadership. And this week, he's going to talk on the A of shape. He already spoke on the S and the H, and today he's going to talk about the A of shape. So let's just do a quick review. Last week, we did principle 3 and 4. Saving is actually delayed spending, and principle 4, power down your debt. I don't know if anybody has any question, or you did something after the class that you're excited about, to let us know. You can type that in the chat. Did you start saving for something? Did you look at your debt? Do you need help in powering your debt down, getting out of debt in 9 years or less than 30 years? So if you have any, if you did something with that, you can just put something in the chat, and I can look at that and might talk to you about that. So let's move on today to principle number 5. Principle number 5 is know the rules. There are a lot of rules that are involved in financing, a lot of rules. And I don't know all of them, so I'm not going to give you all of them, but I'm going to highlight a few of them that I believe are critical in helping you become on this road to financial freedom. So the rules that I'm going to talk about today are rules relating to the market, relating to risk, relating to retirement plan, and taxes. So I'm going to talk on these four rules today, and just highlight a few things about them to help you understand them a little bit better. And if you have any question, after the webinar, we can get together and talk about some of the things that, if you have any questions or concern about this. So the first rule we're going to talk about is the market. Warren Buffett, most of us are familiar with him, has a rule which he calls the gold rule of investing. His rule is, number 1, never lose money. And number 2, he says, never forget rule number 1. So basically the point he's making is, when it comes to investing, is never to lose money. And that is so important. As I talk to you, some of the things that I'm going to explain, you'll understand why it's so important not to lose money, and why you need to understand some of the things that you hear in the market, right? We know the stock market goes up and down. That's how it works, right? Just give you an idea. In 2008, when the market collapsed, $2.3 trillion was lost in retirement savings. And if you remember that, a lot of people who are getting ready to retire, who were in retirement age or getting ready to retire, were all perplexed, and some were disheartened, and some were, basically emotional and broken, because all the money that they've worked for is suddenly just has disappeared in the market. Historically, market corrections happen every 10 years on an average. So you have to understand and aware of that the market goes up, it goes down, it goes up, goes sideways, and all of that. This 2 years ago, right, with COVID, we saw a downturn in the market. When that happened, Motley Fool said about $4.4 trillion was lost in 401k and similar plans. The market has rebounded, but for some people, they might not have rebounded. And I'm going to show something that will get you to understand that. Yes, you look at the market, it's going up, it's making gains, but are you going up? Are you making gains in your personal finance? So as I said, there are three possibilities in the market. It goes up, it goes down, and then it goes sideways. If you know the market was going to continue to go up forever, that would be a great thing to know, right? You will want to dump all your money in there and make as much money as you can, because you know it's going to continue to go up. But that's not how it works, right? If it's going down, you want to get out all of your money out of it, because you don't want to lose it, right? You might hold it in cash, or sometimes you hear commercials, buy gold or buy silver or real estate, right? You want to take it out of the market, but it doesn't do that all the time. So the possibilities that the market would go sideways, that means it will go up, it will go down. So you have to understand some of the things that the market deals with. One of the big challenge with the market is that there's a lot of things that are cliche that you hear in financial news, or you hear financial people talk about, that a lot of average folks like you and me might not understand. Patrick Kelly, some of you don't know it, but he is a big guy in the space that I work in. He wrote a book called The Financial Miracle. And in that book, he wrote a chapter called The Big Lie, where he talks about average return versus actual return. I'm just going to quote what he said in the book. It says, sometimes a lie is told so well that even its perpetrators believe it. Such is the case with stock market averages. Let me see, how can I convey this next thought nicely, gently, in a way that doesn't offend anyone? Sorry, I cannot. Here is the bitter truth. It's a lie, fiction. The average return reported by financial companies are not reality. They are just smoke and mirror. That is a tough statement to make, right? Knowing that every time we listen to news or we look at our statements, they tell us about average return. And here, Patrick Kelly is saying that is all smoke and mirror. It continues, it says hogwash. It says the statement that the average return is 10% may be factually true, but in reality, it's misleading. It's worthless. It says why? Simply, there is a huge difference between the average return and the actual return. So that's why he calls it the big lie. Because what we hear when you listen to the news or you read financial report, it talks about the average return. They seldom talk about actual returns. So most of us buy into average return. So let me just demonstrate what Patrick Kelly is saying. So let's say you have $1,000 and you invest $1,000 in an account. In the first year, you lost 50%. So the market went down 50%. But then in the second year, it went up again 50%. So if you do the math, the average is 0%, right? 50 minus 50 is 0, divided by 2 is 0. 0 divided by 2 is 0. So the average return is 0. Well, let's put a dollar figure to those numbers. Your $1,000, if you lost 50%, went down to $500. When you gained 50%, your account went up to $750. So your actual return is a negative 25%. So factually, the average return is correct, is 0. But your actual return is you just lost 25% of your money. Because your ending balance at the end of second year is only $750, not $1,000. So that's why Patrick Kelly says this is the big lie. Because most people look at average return and they never understand actual return. So what when we talk to clients and work with them, we're looking for places where they understand average return versus actual return, and where their actual return is doing better than their average return. One of the places that you can go and you can check, if you want to check average return versus actual return, is this website. It's a great website. It's called www.moneycheap.com. You can go in there and just look. You can do the last, I think they've been tracking numbers since 1901 or something like that. But you can just take any period and look at the actual return versus what the average return is. Sometimes the average return is telling you it's good, but your actual return is negative. So as we look to save money and invest money and build, we have to understand this dynamic of average return versus actual return. So that when we're looking at what we're doing, we're not concerned about average return, but we want to see our actual return. To buttress that point, let me just put this on charts on the map. JP Morgan, they write a quarterly, it's called the Guide to the Market. They put it out every quarter. This is the numbers for the first quarter of this year. The one that came out first quarter of this year, right? If you look at this chart, you can see that REITs, real estate investment trust, over the last 20 years have been the best producing. I'm not giving you advice on what to do. I'm just reading a chart here so you can see that, right? And then if you look further down here in the orange bar, the average investor is making 2.5% return in the market. Inflation is at 2.2%. So if you look at S&P 500, is returning about 6.1%. So if this S&P is returning 6.5%, which is what we hear every day in the news, how come the average investor is only making 2.5%? So these are things that as you listen to news and you listen to this report, you have to start looking underneath some of these numbers and see, how am I getting 6% in my money? Or am I only getting 2%? Or am I getting more than 6%, which would be great, right? So the first thing we have to understand is the market and pay particular attention to rate of return, average versus actual. The second rule we have to understand is rule about risk. There are a lot of risks that are inherent in life. Some we can avoid, some we cannot. But when it comes to finances, what are your potential risks? What are some of the risks that you face that you have to understand so you can guard and protect yourself against? One is taxation. And I'll talk a little bit about that later because it's one of the rules that I'm talking about in this series is taxation. So I'll skip that and talk about that. Market risk, I just spoke about that. You have to understand the market goes up, it goes down, it goes sideways. You have to understand how it works. Inflation is a risk. The cost of purchasing goods changes, right? Inflation keeps going up. Right now, people are anticipating inflation is going to go higher, right? I remember a couple months ago, we can buy gas for $2.50. Now gas is almost $3, right? So inflation, whatever causes that, but inflation happens. And another risk is emergencies, right? Something you didn't plan for could happen. Disability, this is a big risk. Do you have disability insurance at work? If you are out of work for 6 months, how would that affect you financially? Or if you're out for a year or more than that. So disability is a big risk. Lawsuits, right? These days everybody wants to sue somebody. Fraud is a big risk, right? Going on the internet to the end of the day now, every day, you put things at risk. Outliving your money. Do you know if you have enough money to last you your life expectancy through retirement? Death, that is a risk, right? Are you prepared if something should happen to you for your family to continue the lifestyle that they're living? So some of these risks we can protect ourselves against. Some of them we can purchase insurance, meaning we can transfer the risk from ourselves to a financial company by buying insurance, right? You can buy disability insurance that would protect you if you get disabled or sick, right? You can buy fraud protection. If something happens to you, somebody gets your credit card, you can get covered. You can buy life insurance to protect you in case you die prematurely. So some of these risks are apparent, and we have to make sure we protect ourselves against this risk. That is part of being a good financial steward. Because for example, if you don't have disability insurance and you're out of work for 6 months, you might lose everything that you have because you might not be able to keep paying your bills. And the interesting thing, I don't know if you notice, the postman comes 7 days a week now. They used to come 5 days. Now they come even on Sundays, right? So they keep bringing the bills. So if you're out of work for 6 months, how will that affect you? So there are potential risks to your goal of financial freedom. And you have to make sure you protect yourself against some of these risks because some of them you can protect yourself against them, right? The third area of rules we have to understand is retirement plans. This is critical because all of us want to retire someday. When it comes to retirement plans, they're classified as tax-deferred savings vehicle, and there are a lot of them. Some of them you're familiar with: 401k, 403b, 457, a simple IRA, a traditional IRA. All of these are tax-deferred vehicles. So basically what it means is that your money in those accounts is going to grow tax deferred. The gains that you make are going to go tax deferred. But after today, I want to change the name. I'm not changing the name for the government, that's their name, but I want you to change the name in your mind. I want you to take the word deferred out of it and replace it with the word postponed. And think of them as tax postponed savings vehicle. One of the biggest misconceptions that I see when I talk to people about retirement is that a lot of people believe, I don't know why, that once they retire, the money that they have in their 401k plan, they can take it out and spend it without paying taxes. That is the biggest misconception that I see. People just think, okay, when I'm working, if I take my money out, then they'll penalize me and I'll pay taxes. But once I retire, the money is all mine. No, it's not yours. It's not yours. So that's why I want you, instead of thinking of it as tax deferred, think tax postponement. Because if you think you're postponing the taxes, what else what comes to your mind? Or if I'm postponing it, that means it's due sometime in the future. Because that is what tax deferred vehicles do, or tax postponement, as I call them, savings vehicles do. They do two things. They postpone when the taxes are due, right? That the taxes are not due now, they're due sometime in the future. And the other thing that they do is they postpone the tax calculation. So you don't know what your future tax obligation is going to be in the future, because all of that depends on the government. If the government decides to change the rules, they can take more of your 401k money than you anticipated. So tax deferred vehicles do two things. They postpone the tax when they're due, and they also postpone the tax calculation. So let me help you understand that a little bit. I have a business proposal for you, and I want you to type in the chat box and answer the last question when I get to that. This is the proposal I have for you. You front all the money, you take all the risk, you manage the business on a day-to-day basis. At the end of 30 years, I'll come to you and tell you how much you owe me. Would you want to go into business with me? So let me see all the people that want to go into business with me. You front all the money, you take all the risk, you manage the business. At the end of 30 years, I'll tell you how much you owe me. Anybody want to go in business with me? Come on, man, that's a good business proposal. Yes, I see. You agree with me that this is a horrible business partnership. Yet this is what you do every day when you start a qualified retirement plan with the government. Every retirement plan you start, you go into business with the government. You put your money in there, you do all of that, but they have a stake and a percentage in it. Uncle Sam is your business partner because he owns part of your retirement account. Let me further show you what that means. So let's say you want to contribute $5,000 into individual retirement account and you're in a 25% tax bracket. We teach a rule, which I'll do next, we call the rule of 72, which tells you how long it takes your money to double. So if you divide your interest by 72, it tells you how long your money will double. So for example, if we earn in 10% interest rate, that means our money will double every 7 years. So my 5,000 will double in 7 years to 10,000, and then the 10 will double to 20 in another 7 years. The 20 will double into another 40 in 7 years. But what happened when I started that IRA account was that the government gave me a tax deduction of $1,250 because the year you did your taxes and put on your tax form that you started an IRA, you're going to get a tax break of $1,250 because that money is now going to be considered pre-tax money, so you get a break on your taxes for that. But most of us don't see the money because we just get a big tax refund, right? And we're happy about it. But the government does not forget that they gave you a tax break. So this is what happens. That $1,250, as your money grows at 10%, your tax obligation grows at 10% too. So it goes from $1,250 to $2,500 to $5,000 and then to $10,000. So at age 66, you said, I have $40,000 in my account. And now I want to take my $40,000. Well, you're in a 25% tax bracket. So that $40,000, you're going to give the government 25% of that, which is $10,000. So the question is, where is the tax savings? I thought I was saving from taxes. No, you were just deferring the taxes. And the longer you defer it, the bigger the pie that the government their portion in it grows, right? So every tax deferred vehicle that you have a partner in it, that is the government. Is there a better alternative, right? So instead of putting the money in your traditional 401k, what if you can put it in your Roth? What is the difference in a Roth IRA? So in a Roth IRA, your deposit, the money that you put in is taxed. It's already been taxed. You've paid tax on the money. So your money still grows tax deferred. And when you take it out, you don't pay taxes. You take it out within the stipulated period that they say, right? You don't pay no taxes. In your traditional IRA, you don't pay tax when you put the money in, but when you take it out, you pay tax on the whole thing. You pay tax on everything. And it's counted as ordinary income to you. And when I talk about retirement in the last session, I will tell you why that is not the best way to take your money, for your money to be considered as ordinary income when you're retired, because it would affect your Social Security, it would affect your Medicare, that you might not be aware of. So when we talk about that in 2 weeks, I'll go into a little detail about that. So do you want to pay money on just, what you put in, or do you want to pay money on everything? Because you're going to pay one of these days, right? So in addition to some of those things about taxes when it comes to retirement, with 401k plans, you also have to be aware of fees within the 401k plan. This is a brochure that you can download from the internet, right? It was put out by the U.S. Department of Labor, because the U.S. Department of Labor was chiding investment companies about the fees that were built within the 401k plan that most people that contribute to 401k plans are not aware of. So it took hearings at the Senate and for them to disclose some of the fees that are inherent in 401k plan that a lot of people are not aware of. So let's look at what they found, what the U.S. Department of Labor found out. That they have sales charges, there are management fees, right? There are other fees, right? This category could cover services such as record keeping, furnishing your statement, investment advice. And as it says, this can be either flat fee or can be a percentage of the amount of money that you have. And then there is money to manage the mutual funds that are in your fees to manage the mutual funds that are in your 401k plan, right? Some are front-end load. You have what's called the 12B rule, which are back-end loaded funds. And then some of them, the target dated fund, also have fees. So all of these fees are there in your 401k that you might not be aware of. Some of them are starting to changes. But when the government was looking to this, Forbes magazine said that the average mutual fund fees can run from 3% to as high as 5%. And the conclusion that the government came to, the Department of Labor came to, that these fees can eat up to 30% or more of your savings. And when you get, if you do download that book, you'll see the numbers that the Department of Labor says there. So as you put in money away for retirement, these are some of the things that you have to be aware of, right? Because if you put in money in a 401k that is going to take 30% of your money through fees, then you might want to look at some of the options that that are available to you. So the fourth rule we have to be aware of is taxes. I think, let me see. I have a poll here. Let me ask the question before I bring the poll up, right? Okay. Let me see if I can bring the poll up here. 1 minute. So the question I have for you, if I can go back to that, is if where would you want your money to, how would you want to pay taxes? If you were a farmer, how would you pay taxes? Would you want to pay taxes on your seed, or do you want to pay taxes on the harvest? So I'm going to launch this poll here. And if you can respond to me, I'll appreciate that. If you want to pay on your seed or on your harvest. Okay, all right, okay. It's a smart group here. You know, great. Okay, let me end the poll. Most of you said you want to pay on the seed. Some few people said they want to pay on the harvest. Yes, you want to pay on the seed, because your seed in most cases should be smaller than your harvest, right? Unless you had a devastation or something. But your seed should in most cases be smaller than your harvest. So you want to pay on your seed. So why is that important? Why is that important? Let me go to that. So my next question is, what do you think about future tax rate? Do you think they're going to go lower, they're going to go higher, or they're going to remain the same? Most people tell me that they think taxes are going to go higher, right? Most people say they're going to go higher. We understand that. You just need to listen to the news and you know taxes are going to go higher. So my question, if you think taxes are going to go higher, is postponing tax really a good idea? So since you say taxes are going to go higher, is, if I use the government term, is deferring taxes a good idea, or is postponing taxes a good idea? I don't think it is, right? Because you don't know what it's going to be in the future, right? Because if it's going to go higher than you're paying today, so what should we be doing? We should start tax planning. We should be thinking, not just file your taxes to get your tax refund, but look at every place that you have money and how taxes affect it, right? So that you can do proper tax planning. So at this time, and on my next series, I'll talk a little bit about taxes again. But now I want to bring up my friend, Minister Antonio Chicks, and he is going to talk today about the A in the shape. We spoke about S, we spoke about H, and today he's going to talk about A. So, Minister Chicks, if you're ready, or you need a minute.
Ready to go.
You're ready to go. Okay. All right. Okay. Well, we can go.
So man, I've just listened to the presentation, and not only this week, but the one last week about, what's your real debt versus, your perceived debt and then your real debt.
Yeah.
And it just blew my mind away. And then hearing today about the concept of where and when you should probably pay taxes. Mm-hmm. I just want to say, man, this is some phenomenal information that, man, just keep sharing, keep doing what you're doing, because we need this information. We need this as a community, as people. That knowledge that you have, that you're sharing with us, man, it's just fantastic. And I just want to encourage you to keep giving it. It's really doing some good stuff. So
thank you,
appreciate it.
Oh
man, it's just a thanks for letting me just be around it. So let's go ahead and recap what we did already. We've already talked about. We're actually breaking down the word shape and how we can shape our leadership, and how our self-leadership actually impacts our finances, because our finances is a part of how we lead ourselves. And so we started out with the S in shape, was to have tenacity in our leadership when it comes to finances, and that is making sure we have wisdom, understanding, and discernment when it comes to our money and our finances. Then we went into the H. The H was to have a healthy heart, and we were not necessarily talking about the heart that's pumping. We're talking about the heart of who we are, our mind, our will, and our emotions, which leads us to the day. Ralph has given us some jewels, some nuggets, but if we don't take action on these jewels, these nuggets, these pearls of wisdom, what does it profit us? So we're going to talk about today is the A in shape, and that's going to be taking massive, calculated action. I mean, really thinking it through. So there's this statement that goes something like this: if you wait long enough, it'll get better, or things will get better over time. Well, here's the bubble buster to that, is that if you take no action over time, the only thing that actually changes is that time passes you by. Time just passes you by. That's the only thing that changes if you do no action. Time passes by. So we have to kind of like change the way we think about time, because you can't control it. Because right now, time just went by. A minute just went by. You can't slow it down. You can't increase it. You can't decrease it. All you can do is do what you can do, and that's controlling your actions within that time. So nothing gets better. But wishing that our finances would get better is not a strategy for success. Wishing that our finances get better is not a strategy for success. Somebody should have wrote that in the chat. But yeah, you can't just sit and wish. You can't sit and wait. You have to take action to make something happen. So I like this thing about action. There was a book out a few years ago that I purchased. It's called Action Has No Season. So what that means for you and I is that at any time we want to get started, it's never too late. Anytime we want to get started, it's never too late. So if you're thinking, man, this finance thing has to deal with, time in the game, there is any time that you're ready, when you're ready to make a decision to move forward and take action, that's the right time. So you can actually start today. This is just some phenomenal stuff. But I don't just want to talk just from my head. I want to actually go and share just a couple of thoughts from a good book that we have, where God is actually encouraging his people to take action. Now, you may have several items that you can recall. I'm just going to go over a couple. If you would go with me, if you do have your Bible with you, maybe you have an app or a phone or something like that, or a tablet. If you want to go to Exodus 14, I'll give you a minute to get there. Exodus 14. And there was some funny stuff in here, when God is talking to his people. So when you get to Exodus 14, this is the children of Israel have already left Egypt, and they come to the Red Sea, and the soldiers are behind them. Pharaoh's soldiers are behind them. The Red Sea is in front of them. And there's a situation at hand, because they don't know what to do. If they go into the water, they can drown. If they don't do anything, the soldiers are going to come through and get them. So God says to Moses, and this is really good. If you start at verse 4, let's say chapter 14 of Exodus, verse 15 and 16. This is so funny. He said, and the Lord says to Moses, I'm reading the New King James version, 15. And the Lord said to Moses, why do you cry out to me? Big question mark right there. He said, why do you cry out to me? Then he goes on and says, tell the children of Israel to do what? To go forward. So in essence, he said, what are you crying to me for? And so sometimes we get held up in waiting, but God clearly here said, what are you waiting for? Do something, make some action. And he said here, he says, but lift up your rod. He gives them some instructions on what to do. Lift up your rod and stretch out your hand over the sea and divide it. So there's a clear example of God was like, yeah, okay, all right, you need to do something. And sometimes we're thinking, man, let me just wait. And that's all that happens. We're just waiting. But we need to actually do something with that waiting. We'll get to that too. The second scripture, oh my God, if you go over to 1 Samuel, and I'll go there with you. First Samuel, and we're going to go to chapter 30. This is so interesting. This is a conversation with David and the Lord in First Samuel, verse 30. It was really cool. Chapter 30 and verse 8. Chapter 30, verse 8. If you're tracking with me, say amen. If you're tracking with me, say amen in chat. Verse 30. Let me get down here as well. So David has just come back. Him and his men came back from, and what they find in their camp is the Amalekites have taken their family, their children, and some of their property and things like that, and just took it away. And so David is under some distress here because even his own men are thinking about stoning him because they're blaming him for what has happened because they were not there to protect their family. And so David has to encourage himself, and so he's praying to the Lord. So one of the things, down here in verse 30, verse 8, let me get there. I'm so excited about when I see this, I get so excited. This is like really good confirmation about what God is doing in our lives and how even Ralph today is just, just really helping us. So David inquired of the Lord, saying, shall I pursue the truth? So here again, David is like, man, I don't know what to do. I'm under distress. I'm praying to the Lord. And then he said, Lord, should I pursue these troops? And then he said, shall I even overtake them? And he answered him. This is the Lord answering David. Y'all see the word right there? Pursue. God told David to look, get moving, get yourself going, do something to reclaim what's yours. So here, and it goes even further, it said, he answered him, pursue. For you shall surely overtake them, and without fail, recover all. Did y'all see that? Y'all see that right there? God told David, look, let's get to work here, get after the people, and reclaim what is yours. So some of us have, had some time where we haven't been putting our proper savings in place, but God can redeem the time for us when we get started. We actually have to give God something to work with. And so he told, Moses to do something. He told David to do something. And then I looked over in James, the book of James, and I didn't find just one scripture, but multiple scriptures in chapter 2 of James, where it talks about faith without works is dead. So, it's a show me, you got to do something, not just have the faith that it was going to happen, but you got to actually put something in motion. You have to put something in motion, and God will work with your motion. Isn't that something? God will work with your motion. That's just a happy thing. So if you get a chance in your studies and your reading time, go to James, and specifically in chapter 2, and all throughout that, you got verse 17, you got verse 20, you got verse 26. And I just said, this whole chapter is about taking action along with your faith. And when we do that, we can start getting these principles that Ralph is telling us will start to work in our favor. Thank you.
Thanks, Antonio. Appreciate that. What a great word, action, right? Even the word itself has movement in it. Action.
That's correct. Isn't that something?
Yeah. Yep. Okay, so now let me continue. Go to principle number 6. Know that the rules change, right? I spoke about a lot of rules that you have to understand, and now I'm just going to talk about know that the rules change. And what I'm going to do, because there's so many changes in the rules, but I'm going to highlight 2 rules, two recent changes that have happened, because they are laws that were passed by the government. They go across a lot of the things that we already talked about. It's about savings, about retirement, and all of that. So you would see how these changes affect some of the things that we do. So I'm going to highlight these 2 recent law changes. And there's a whole lot more with them, but I'm just going to highlight some of the things so that you can understand them. Excuse me. Let me go to the first one. the Tax Cut and Jobs Act of 2017. I like these government people. They got some nice names for for laws that they make. You know, this law was signed in December of 2017, and it was the most sweeping tax legislation since 1986. It is the most sweeping tax legislation since 1986. But the thing with the Tax and Cut and Jobs Act of 2017 was that it had a start date, but it also had an ending date. This law was going to be in effect from 2018, and it will sunset in 2025. So the way the politicians negotiated to get this law going was that, okay, we'll get you what you need, but at the end of 2025, the law is going to revert back to what it used to be before 2018. So that's why this particular law had an end date, 2025. So some of the things that I'm going to talk about might not wait till 2025 because they might change them, but some of the things will end in 2025. So what are some of the changes that this law brought to us? First of all, it changed the tax brackets. The lowest tax bracket was 10%. The highest tax bracket was 39.6%. This law changed that, made it 10%, the lowest, and the highest was 37%. And in doing that, it also changed the amount of income that would fall within a bracket. So they move. So when they change tax laws, they not only change the bracket sometimes, right? 10, 12, 15%, whatever percentage. But within those, they also change the numbers, the amount of income that would fall within a certain percentage. So for example, 27, before 27, prior to 2017, the top, if you pay the top tax bracket if your income was $418,000 and you're single. For joint filers, it was $470,000. After 2018, for single people, it was $500,000, and for joint, it was $600,000. So those are some of the changes that happened that law made. Another change that came from this law was the family tax credit. The family tax credit was double. It was moved from $1,000 to $2,000 if you have a child under age 17. So those were changes that came because of this law. The other change that came had to do with Roth IRAs, right? Beginning December or beginning January 1, if you convert your Roth, because just to give some history, IRAs have been around for a long time, probably 40, 50 years. And in the 1990s, they started Roth IRAs. So the government was allowing you when the law came into being to transfer your traditional IRA to your Roth and don't pay taxes and all that. They gave you a window to do that. But they also have been allowing people to recharacterize. It's called recharacterization, where you would if you change your traditionally to Roth, they will allow you to move it back to tradition if you choose to, because for whatever reason you might want to do that, which I don't know, but maybe you have some reason to do that. But they put an end to that. You cannot do that anymore after December 31st. So if you already moved it from a traditional to a Roth, you can't go back and change it from a Roth to tradition. So they changed that. Medical expense deduction, right? That was also changed. The threshold was reduced from 10% to 7.5%. For people that have, major medical issues, that was a big difference to them. was moved from 10% to 7.5%. Mortgage interest deductions, right? If you own a home, you know there was changes made to that on how you could deduct, what can be deducted and what cannot be deducted. So all these changes affect your money. Personal exemption, it was changed from 6,000 to 12,000 per single, and then 12,000 to 24,000 per couple. But then with that, you lost some of the other deductions that you will get. So I'm saying all of this because, as you can see, rules change. The government, you know, they like changing the rules on us. So you have to be aware of how these rules change, how these changes affect you, affect your finance, affect the things that you're doing with your money. Because if you don't know how it affects you, it's not like somebody's going to come knock on your door and say, hey, you know, the government just changed this rule. And because some of these things are so deep down in the detail that you might not even notice it. That's why, you know, we always recommend you have a financial team, or you have, you know, not only maybe a tax guy that helps you with that and can update you on current changes with tax law, but a financial person, because there are some things that we would learn from new laws that come into being that's probably, you know, somebody who's in tax or who's a lawyer might not affect them because it's not part of their wheelhouse. You have a lawyer, you have all of these people that you can because you're doing your job, you working. If you're not in these disciplines, you don't even know some of these changes that there, but they do still affect you, you know, because it's the law. Like they say, ignorance of the law, right, is no excuse. So we have to be aware that the laws change. Government. So every time you hear the Senate is meeting and they're doing something, it should interest you. Or the House is meeting and they're passing this bill, it should interest you because they might have something there that would affect you financially, would affect your finance. So let me move on to the last thing there was an individual mandate, right? Before 2017, if you don't have health insurance, when you file your taxes, you have to pay a penalty. Well, that penalty was taken away with this law. So now, if you don't have health insurance, there is no penalty as it used to be. So the second law that I want to highlight is the Secure Act of 2020. You know, like I said, I like how they give these laws names, right? The Secure Act stands for Setting Every Community Up for Retirement Enhancement. Setting Every Community Up for Retirement Enhancement Act. This act, right, they wanted to do something to improve retirement. I don't know. They did some, but they took some benefits away too. One hand gives and the other taketh away, right? So let's just see what should we be aware of with this new law, right? The first one is inherited IRAs. Prior to this law, if you have a retirement account, an IRA, and you pass, and it goes to your children, right? Maybe it goes to your spouse first, and she passes, and the money goes to your children. Your children had their lifetime to distribute that money, so they can spread it over time on how much they take out of that account to pay the taxes on it. Because remember, when you have a tax deferred vehicle, you have an account that the government owns a share in it. So the government wants their money. So prior to this rule, you can extend the years that you take the money out throughout your life expectancy. So if the money transfers to somebody in their 40s, they can stretch that money and take it out till their age 80, 85 and pay the little taxes as they go along. A lot of people like that. It was even given a name. It's called the stretch IRA, right? Because they stretch it over time. Well, this law came in and it changed that. The law says if you get an inheritance, an IRA inheritance, and you're not the spouse, Now you only have 10 years to liquidate that IRA. So they change it from lifetime to 10 years. Why? Because the government wants to get their share out of it as soon as possible. So so this has become a big challenge for a lot of people that were looking at their IRAs and those accounts to leave, for inheritance for their kids or grandkids. Now they have to make some decisions about those money because now they cannot stretch it anymore. Once they transfer the money to the beneficiary, they have to get, liquidated in 10 years. So that's a big rule. You might not have paid attention to it, but for us in the financial business, it has been a big rule, and it's causing people to rethink where their money is and what they're going to do with it. The second one is the required minimum distribution. As I told you, if you have a tax deferred vehicle for retirement, you're in business with the government, right? So the government has a rule, required minimum distribution, meaning that at a certain age, you have to start taking money out of your IRA or 401k. So what this law did was the age used to be 70.5 when you have to start taking money out, distributing the funds out of the account so you can pay the government their taxes. This law moved that from 70.5 to 72. So at 72, if you have a 401k, you have to start distributing the money out. And the last week when I talk about retirement, you will understand why it is important you understand the required minimum distribution rules. Because if you don't do the minimum required distribution, if you don't take the money out, there's a penalty. IRS will penalize you 50% of the amount that you should have taken out. So let's say the government says your required minimum distribution is 10,000 and you don't take it out, then they'll penalize that 10,000. You'll pay 50% of that money in penalty. So you have to understand all of these rules, right? Another rule is, qualified charitable deductions. These, for people who want to leave money for charity and all of that, you can take money from your IRA and give it to your church, right? To qualify charity, you can do that. They allow you to do that. So those are called qualified charitable deductions. And for some people, it might be a good strategy to avoid taxes to do that, because now you don't have to pay taxes on the money anymore because you're giving it to a charity. So there are tax strategies and with regards to that. The other thing that changed, one of the other things that it changed is the 529 plans. What they do was expanded who can participate in the 529 plans, right? Now they've included elementary school and primary or secondary school to participate. It used to be 529 was just for college. They've also included apprenticeship, registered apprenticeship. If you want to do an apprenticeship, and you have a 529 plan, you can use the money for that. It doesn't have to just be for college or university. And one of the other things that they did was now they can allow you, if you have a 529 plan, you can take up to $10,000 of that amount to repay your student loan, and there would not be any penalty or anything with that. So they made some allowances with that. The other thing that they did with this new law was for people who want to adopt kids, right, or for birth of a child, they would allow you to take money from your 401k plan up to $5,000 without that 10% penalty for early withdrawal. So you can do that. If you're a couple, that means you can get $10,000 from your 401k without paying the 10% penalty. So these are rules that are available out there. Annuities, retirement plan going into the future will have annuities in them. So most retirement plan, most 401k plans only have mutual funds in them. But But now they've made provisions for annuities to be within your 401k plan. And the reason is because annuities are the only vehicles that can give you guaranteed income. Your mutual fund cannot give you a guaranteed income, but an annuity can give you a guaranteed income. So the government is looking at ways to make sure that, because if you have all your money in the stock market and when you're ready to retire, the market drops, you've lost your retirement, right? You've lost a significant amount of that. But if your money is in an annuity within your retirement, you know you can still get a specific amount of money every month or every year, depending on how it is set up. So there are also changes there for employees. If you're a small business person and you want to set up a retirement plan and you don't think you can do it by yourself, you can form a group with some other small business people and you can do what is called a multi-employee plan. So there are a lot of changes that these two laws, within the last 3 years have added when it comes to savings and retirement and all of these things that we do. So it is so important that we understand that these rules change. And sometimes they change rather frequently. We just had an election. We have a new leaders, and there are certain things that they want, and there are certain things that they didn't like. So they're going to write the laws, and some of it might affect your savings. It might give you some benefit, but it might take some benefit away from you. So we have to be aware and pay attention to these rules because these rules change. So those are the two laws I'm going to highlight because they're the most recent ones that have significantly changed a lot of things that used to be. At this point, before I close here, I have a poll that if you can, let me launch this poll. This is somebody saying something here to me on the chat. Can I click this door? Okay, somebody asked about the birth and adoption law. Yes, basically with the birth and adoption law, is you can take money, to because it takes money for the expense, right? To cover your expense. You can take that money from your 401k now. If you have a 401k, and they won't penalize you that 10% as they normally did. Because if you remember, most 401ks, you have to show hardship to take money out of it and all of those things. Well, now birth and adoption is one exemption that will allow you to take money out of your account. Okay? All right. So let me put up my last poll. Okay. So this is launch my last poll. So if you can just answer this for me. Yes. So we'll take about 50 seconds to answer that poll. Go to the chat. So if you can answer the poll for me, I'll appreciate that so that we can finish. Almost a little bit over time. Okay, identify your source, yes. Okay. All right, we'll stop the poll in 5 seconds. Appreciate the feedback. All right, so let me end the poll and just share the results here. So most of you said you've identified your source of income during retirement. That is great. You know how much income you need during retirement. Okay, most people don't. And that is something that we need to work on, because if you've identified the source, you have to identify, how much of that you would need to see if what you have right now will be enough for that. So, and would you like to stress test your retirement plan? Most of you said yes. Okay. Um, if you would want to do that, we can talk. You can reach out to me and we can talk about that. Set a time to talk. Probably do a Zoom meeting and just see how we're able to help you. So let me exit the polls. So as I finish here, just want to remind you all that we do have a private Facebook group, and we encourage you to join the group. And last week I was asked about WhatsApp. Yes, I did have a WhatsApp account, and you can reach me through WhatsApp with my telephone number. And there's a group that I've set within that for this particular series, The Road to Financial Freedom. So if you want to be in that, if WhatsApp is what you want to deal with, that's fine. Just check me on 240-723-8725, and you can find me on WhatsApp, and I can link you with the group. And so again, I want to thank you for your time. I don't take it for granted because that you come out on a Saturday for an hour to listen to me talk. I hope it's beneficial to you. I hope you getting learning a lot. It's important that happens, that you find value in what we do. So if you have any question, please reach out to me and let me know how I can be of service to you. Okay. So let me see. Last chat here. Something to say. Yes, thank you. I appreciate it. I appreciate that. You guys getting back with me on that. I want to thank you for being here. And next week we're going to dive a little deeper into some things about taxation and retirement planning, because I know for all of us that is where we want to be. We want to make sure that we're prepared for retirement when it gets here. So again, I want to thank you for your time, and I appreciate you being here. You all have a wonderful week. Enjoy, and happy Easter to you all. Appreciate you, and let's go celebrate Easter. So thank you very much, all of you. Appreciate that. See you next week.